People keep asking me about the whole Netflix and Warner Brothers deal. Should I buy Netflix? I've got to be real with you. I don't chase headlines. I follow the ratings. See, while everyone and their brother has been debating Netflix, I simply use the Zen ratings model to quickly identify 3 top-rated entertainment stocks. Those 3 stocks scored an A, which means strong buy and likely to outperform, whereas Netflix only scores a meager C rating, which means it's kind of ho-hum. The difference, A-rated stocks have averaged over 32% returns per year going all the way back to 2003. That is 4 times better than C-rated shares. A serious advantage. So today I'm showing you 3 stocks in the entertainment and streaming space that rate higher than Netflix, better fundamentals, stronger momentum, and Wall Street is starting to take notice. Before we get into the stocks, well, who am I? I'm Steve Reitmeister. I've been investing for over 40 years, and I was the editor-in-chief at Zacks.com for many years, helping to make it one of the largest and most respected investment websites. I've lived through the dot-com crash, the Great Recession, and every market cycle in between. Now I'm a partner at WallStreetZen, where I use all that experience to help develop the Zen ratings model. This AI-driven quant system helps everyday investors simplify stock research by distilling 115 different factors proven to drive up stock prices into an easy-to-read letter grade. Just like our grades in school, we get rewarded for A's and B's, not so much for the rest. So when I tell you these 3 stocks rate higher than Netflix, I'm not guessing. The math is spoken. Let's start with stock number 1, which is Alliance Entertainment with a symbol of AENT. This is a name you probably haven't heard, which is exactly why I'm putting on my list today. AENT is what I call a diversified infrastructure play in entertainment. They're involved in e-commerce, wholesale distribution, and media. They sell everything from vinyl records to pop culture collectibles. Think of this company as the middleman that wins regardless of who's streaming what. When vinyl sales surge, they profit. When collectibles for Marvel figures go up, they profit. When retailers need entertainment products, you guessed it, they profit. They're the infrastructure underneath the entertainment industry. And here's why I'm watching it now. First, diversification equals resilience. AENT doesn't live or die by Netflix moves or Disney strategy. They benefit from multiple revenue streams. That's risk management expertly built into their business model. Second, the Zen rating system gives AENT a strong buy rating. And when you look at the recent price action, you can see the institutional money flows coming in. This stock's been climbing over the last few months with signs that it has plenty more room to run. That's not retail hype. That's about the smart money recognizing value and taking action. Third, let's talk about insider buying. When I look at the insider activity, I saw CEO Robert Black and other executives buying shares, not selling, buying. That's their own money on the line. That's serious conviction from management. Now, full transparency. AENT is more volatile than your typical blue chip stock. The stock moves a lot. But here's the one thing I've learned over the last 40 years. Higher volatility plus strong fundamentals like these is a winning formula. You just need to calmly stomach those rough days to enjoy all the upside that unfolds on those extended bull runs. Look, I'm not saying AENT is a sure thing. Nothing is. But when the Zen ratings say strong buys and the business model is so well diversified and insiders are buying, then I'm going to pay serious attention. All right, that's stock number 1. Let's move on to number 2. If you made it this far, you're serious about investing, so do me a favor. Subscribe to this channel. I release picks like this every week. Stocks the market's overlooking. No hype, no nonsense, just strong fundamentals and top ratings. Hit subscribe so you don't miss the next one. Okay, next up we have IMAX with a symbol of IMAX. Yes, the large screen movie company. And yes, I know what you're thinking, Steve, aren't theaters dead? Not even close. Here's the thing about IMAX. They offer a large screen format experience that streaming can't match. Sure, you can watch Dune on your couch, or you can watch it on a 6-story screen with sound that puts hair on your chest. There's simply no comparison. I don't know if you've noticed, but movies are back. Drive past the theater and you'll see the crowds, families, teenagers, couples. That tells you more than any analyst report could. People still want experiences, and IMAX is the ultimate movie-going experience. Now, let's talk about the data. First, growth and safety in a shaky sector. The entertainment industry overall has been rough, but there is a good reason why IMAX has a Zen rating of overall with B grades across growth, safety, and financial strength. In a volatile sector, IMAX is the steady hand. They're expanding system installations globally. Film for IMAX content is increasing, and they just posted a record-breaking Thanksgiving weekend. Second, the Wall Street consensus is quite bullish. 5 analysts rate it as a strong buy, and 2 more say it's a buy. Right now, IMAX is trading in the high 30s, while average forecast of 47 suggests about 26% upside from here, and that may prove to be on the low side. Third, let's consider the international expansion. IMAX isn't just a U.S. story. They're installing systems in Asia, Europe, and Latin America. As global middle classes grow, so does demand for premium entertainment. IMAX is positioning itself to capture that growing demand. Now, I won't sugarcoat it. Netflix's push for shorter theatrical windows is a headwind. That's real. But IMAX isn't standing still. They're adapting, partnering with filmmakers, and doubling down on what makes them unique. And frankly, when a business has an economic moat this wide, this strong, when they literally own the premium large format theater market, it might be worth riding out some short-term noise. That's stock number 2. Let's hit number 3, which is Roku, with a symbol of Roku, the streaming platform that's not Netflix, but works with Netflix and just about everyone else. Here's why Roku's strategy is so brilliant. They don't compete with content. They distribute it. Think of it this way. Roku is the highway to Netflix, to Hulu, to Disney+, Apple TV, HBO Max, and on and on and on. They're all cars driving on Roku's road, and Roku collects the toll in all directions. It doesn't matter who wins the streaming wars. Roku wins because everyone uses their platform. That's the Switzerland strategy, staying neutral, benefiting from all sides. Now, the data starting with the growth strategy. Let's talk about that. Roku has a Zen rating of B overall with a matching B grade for growth. Most interesting is the A rating for sentiment, meaning the smart money is already aboard the stock. The growth story is easy to appreciate. That's because streaming hours on Roku keep climbing. Advertising revenue is expanding, and as more cord cutters enter the market, Roku's install base grows. Second, let's talk about Wall Street confidence. 8 analysts label Roku as a strong buy, 3 more say it's a buy, and only 4 in the hold category. The stock's currently trading in the 110 range, yet the average analyst forecast shows 33% upside for shares in the coming year. Third, let's talk about industry developments. Ad dollars are shifting from linear TV to connected TV. Roku is a primary beneficiary of that migration. Plus, more streaming services are offering ad-supported tiers, expanding Roku's total ad inventory without needing new users. Look, Roku has its ups and downs. I'm not going to pretend otherwise, but if you believe streaming is here to stay, and you should, then Roku is the definitive platform play. It's not about which content wins, it's about how much we are watching TV. And right now, millions of people watch on Roku every day, with more climbing aboard. So, there you have it. 3 stocks much more attractive than Netflix, Alliance Entertainment, IMAX, and Roku. So here's my question for you. Which of these 3 stocks interest you the most? AENT is the diversified play, IMAX given the large moat and market dominance in large screen formats, or Roku for having that thriving platform strategy? Drop a comment below and let me know. This is WallStreetZen.com, the home of the Zen ratings. You can look up any stock and see its ratings for free. It's simple and intuitive with grades between A to F. Just like school where we get rewarded for those A's and B's, please avoid the rest. Beyond the overall grade based upon 115 different fundamental factors, we also break down the rating into key areas like growth, value, momentum, financials, safety, sentiment, and even our exclusive AI factors. I use this every single day and is the basis of all my stock picking decisions given the proven outperformance packed into the ratings. There's a link in the description if you want to look up your own stocks. Just type in those stocks I talked about today or your favorite stocks to see how they rate. Now, if you like these entertainment picks, be sure to check out my next video sharing 3 other stocks poised to benefit from the next wave of the AI revolution.